What's up, guys? Swimming back to back, and I hit another video in tonight. So we're gonna get into hedging with financial derivatives. Boy, this is going to probably be a three-part video, simply for the fact that I do not want to talk about a lot of things in a short period of time. I want to make sure that everything is understandable and simple with all the terms and knowledge that comes with this. So for this information, it's probably going to be a three-part video because there are certain sectors that I need to break down in the simplest of ways for you guys. So let's go hedging with financial derivatives. Let's start. Hedging. So what is hedging? Hedging is protecting yourself. So to make it simple, it's engaging in a financial transaction that reduces or eliminates risk. Now, as we know, there's risk to everything that we do in terms of the market, that when you invest, you take a risk. Whenever you put money forth to try and get a return on it, there is a risk involved. So you have positions. Now, you have long and short. Now, people commonly prefer saying buy or sell, but we're going to break these things down. Remember, this is hedging. So long position are things to be purchased or owned as assets. To be purchased or owned as assets. So that means you're going to either purchase it soon or you're going to make it your asset. Short position, an asset which must be delivered to a third party as at a future date, or asset which is borrowed and sold but must be replaced in the future. This is hedging. So long position, you're going to own that asset or you're going to purchase it soon. Short position, you got to deliver it to somebody on a future date, or it's borrowed and sold, but it must be replaced in the future. So to offset a long position, you take a short position. To offset a short position, you take a long position. That goes in hedging. So that is where reduce, eliminate risk, because to offset a long position, so let's say that you want to purchase something or own something, but you're saying, okay, well, what if there's some risk involved with that? So in order to offset that, you say, well, if I own that asset, I can just go ahead and deliver it to somebody else, or if it's borrowed and sold, I can replace it in the future, so I can offset any balance or offset any money that I put in or money that goes out, so that I won't have to worry about having as much risk putting all my money into one thing. So same goes with long, short, short, long. Now we're going to talk about forward contracts. There's forwards and futures that I really want to get into and dive in. So forward contracts is when two parties agree and engage in a financial transaction in the future. So you're saying, well, how do they engage in the future? So they have a certain specification of things that are going to be delivered. So number one, when your two parties agree and engage in a financial transaction in the future, they have the list of exact assets to be delivered. So they'll have a list of what's going to be delivered at the time, the location of where the assets are going or where you're going to pick them up, etc., the price that's paid, and the date of exchange for the cash and the assets. So with the forward contract is that, okay, we're going to agree to have, let's say you want to deliver 1,000 barrels a week. Okay, and so when you get to that financial transaction, you're saying, okay, I'm going to deliver 1,000 barrels a week, and then we're going to deliver it at a certain location. Let's say you're in the UK. I just popped that out of my head. Deliver in the UK. Let's say you're going to pay about 1,200, and the day in exchange is going to be the next Friday for the cash and the assets. So basically, the forward contract is saying that we're going to have an exchange at a certain time. These are the parameters. They're set in stone. So long position, short position on these things. So the long position agrees to buy at a future date. So now we're talking about securities though. So let's just talk about securities and say the long position agrees to buy securities at a future date. So when you buy at a future date, you have the future interest rate that's locked in, because as you lock in a future interest rate of funds, you avoid rate decline. So it's not the spot rate, it's the future rate. So short position, you agree to sell securities at a future date, reducing pricing risk from interest rate increase. So what am I saying? So whenever you have a forward contract, you at a long position, you agree to buy. So this will get to the buy and sell terminology of long and short. So forward contracts, when you want to be in a long position, you're the buyer. So you say, I'm going to buy securities a month from now, 2 months from now on this exact date. So you lock in that interest rate of the funds and you're saying, okay, this is the rate I'm going to get for the future. I'm not going to have a rate decline. So that way you don't have to worry about rates jumping from daily and varying and having variability. You're going to say, okay, this is the rate I'm going to get. If it goes up, if it goes down, it doesn't matter. I've locked it in. If you're a seller, your short position, you will sell them at the future date, which means you reduce the price and risk from interest rate increase. So if interest rates go up, you're like, oh man, I'm going to pay more. But you too get to say, okay, I'm going to lock in this rate because the parameters are already set. That's a forward contract. The parameters are already set. See, and the thing is about forward contracts is that they are flexible, but they lack liquidity because it's hard to find a counterparty. It's hard to find somebody that wants to agree to specific parameters that you may want to put forth, and they say, okay, yeah, I'm cool with that 100%. And it's subject to default risk because the party may not have money to buy the entire contract. So it depends. So those forward contracts, two parties agree to engage that financial transaction, and it's going to have all the parameters, but it depends. Will you find a counterparty to say, hey, I agree? Now, we're going to get into futures. So one thing I want to say about forward and futures, the futures are that they have specific delivery type of security at future date, have arbitrage at expiration date and the price of the contract, and then the rate increase for a long equals a long contract. So the whole thing is about futures contracts is that they lose in the spot market. So what is the spot market? It means as of right now. Like I said, so you have the spot rate, you have the future rate. Spot rate is as of right now. Future rate is as of whenever in the future you're going to lock it in. So that's what happens with forward contracts, that you can lock in that future rate. And it has losses in the spot T-bond market are offset by gains in T-bond futures market. So you're saying, what are you saying? So let's go back to how we talked about hedging, about how to offset a short position. You take a long position. To offset a long position, you take a short position. So with the future, let's say you have an investment in the spot T-bond market right now. So treasury bond market, and you're like, man, I'm taking a loss right now because all the rates are going down. But think about you buying something for the future in the T-bond market, and you're saying, well, the rates are going up for the future, so now I have everything to offset. This is what happens with futures contracts, because you may have a loss now, but you buy for the future and the rates go up, then boom, you're good. So obviously with bonds, there is an inverse between price and yield, but let's just say that not for a bond example, let's just say for a regular example of that, hey, you're buying a future and you're in a spot right now for, say, any security. Let's not say bonds. So if anything goes down right now, but things go up in the future, you have offset it because you're saying, okay, that future rate is locked in, so I'm good. So what you really need to know is that financial future contracts specifies delivery type of securities at any future date. You have arbitrage, so you have the ability to probably make a profit at expiration date, and then the rate increase on long contract, price of underlying asset delivered has loss, but the short has a profit. So you have two types of hedges with this, is micro and macro hedging, which is micro is the hedging value of a specific asset. Macro hedging is the hedging of the entire portfolio. So micro hedge, you can say, I just want this one thing to be hedged off, just this one specific asset. Macro hedge, say, screw it, the whole portfolio or general prices for the inputs are going to be hedged overall. So whenever you have a forward or futures contract, you have to understand what's being delivered, what date, and how things are affected in certain times of the market. So you have spot and you have future. I expect, is it going to be affected now or is it going to be affected later? So that is how I wanted to break it down, guys. I hope it was very informative for you. I hope that it helped a lot. I try to break it down very simply because these things are very, very, very tough to understand when it comes to not knowing finance. So I'll probably have to add up a follow-up video with my next video just to explain a little bit more before I get into the next topic. But thank you guys for watching. Hope you guys enjoyed. Tune in next time.